Everybody, it's Michael Martin. Thanks for being here. Most of the time I'm doing these daily 5 to 10 minute monologues. Sometimes one day gets a little longer than the other, but I try to keep it short and sweet, make my point and be done. As I like to say, if I can't say it in 5 minutes, I can't really say it. Very rarely do I interview folks just because of the way of doing stuff. And this is kind of a bit of a niche. And I don't think you need to have a lot of discussion about the psychology or the emotional intelligence around trading. But every now and then I have a guest on, and that's going to be the case today because he's just written a great book. The problem with trading books anymore is I feel like they're an amalgamation of things that have already been said, and someone's kind of putting their take or their understanding. And I've written a book, right? It's easy to write. It's very, very hard to write well. I'm going to let the public figure out whether or not my book is well written or not. It's not for me to say. I wrote the book I wanted to write. But having said that, there's some new work. And I want to have the author on today. His name's Shannon. But before I get there, I want to stick to this other point real quick. And that is a lot of the trading books today kind of take what's already out there and they kind of reword what's already there. So there's not a lot that's new. And so it makes reading trading books, for me anyway, not all that great. I got Trader Vic's book. Victor's a good friend, partner of mine. I have Chester Keltner's book, How to Make Money in Commodities. This cheesy title notwithstanding, there's a great book on the evolution of Keltner channels and this and that. I have Edwards and McGee, right? So I have a lot of great books. And I think over time, it might be too easy to say, but my good friend Shannon just wrote a book on anchored VWAP. And I think it's great. It's a great book. It's a book that you can have as a reference book to understand what anchored VWAP is. But it's also a playbook in that there are at least 9 strategies in there on how you can take VWAP and kind of use it in your own trading. Now, there's probably 100 ways you can use it. He discusses 9. We're going to talk about those today. Stay tuned. Here's Shannon. Hey, everybody. Welcome to the show. Hope you enjoyed my long-winded introduction. We got my good friend here, Shannon, who I was trying to think. I must know Brian for about 20 years. I know we met back in Malibu near Pierce Brosnan's house, past Zuma, way back when. And then I know I saw you because I had admired your work. And I think I ran into you at an event where either you were speaking or we were both speaking, or we were speaking, but on different days. And I remember going up and saying hi to you. Folks, today we're celebrating Brian's new book. And I do mean celebrate because this thing, as I mentioned in the intro, is ass kicking. I think, as I mentioned, if you're a newer person and you're looking to try to figure out where is your edge, anchored VWAP, it's not VWAP, is a great place to start because it really tells you who cares and at what prices. Brian, congratulations on this great book. It's your second book. I have the other one too somewhere. It's in my bookshelf. So
thank you.
Please go buy this book. It's the best $60 you can spend. And we're going to talk a little bit about it today. There's a lot in it. It's very pithy. But man, congratulations. I know you're getting a lot of good press and from people who know the difference too. It's not just these books on technical analysis where, man, people send me review copies and it's like, okay, I saw this in Edwards McGee. I saw this in Chester Keltner's original book. I saw this in Wells Wilder's original book, or I saw it in Bella's book, the playbook, right? So this is all original thought, man. So that's kudos to you because it's really hard to do. It's very well written.
Thank you, Michael. That means a lot coming from you, especially. I mean, you know your stuff. And I knew when I sat down with you today that I don't know what we're going to talk about yet because we haven't discussed that, but I know it's going to be thought provoking because when you dig into it, you dig into it. And, I know that you've read it and that means a lot.
Yeah, this thing is dog-eared to the max. I'll have to get another copy to actually hold because this thing is beat to crap already. There's so much in here, folks. It's almost like, where do you start? But the point being is, and I mentioned this in my blurb, here's another thing about this book. There are more people who have written blurbs in terms of the total pages than there is the index, to give you an idea of what high regard people hold Brian and his work. And I'm not even exaggerating. There's a who's who of people who know their crap and have stepped up. So in my comment, I said, institutions leave footprints, right? And that's one thing that a mutual friend of ours, Scott Kaminsky, had taught me way back from when he was at Tudor. And he's like, small speculators, of course they matter. They're important people, but it's the institutions who can really push things around, especially in the equity space. In futures, it's a little different because the cash market drives futures. But in the equity space, there's only one instrument of Tesla. It's not like natural gas where you've got 20 years of depth on the calendar. So this strategy, there's several trading strategies in here, but what it does is it marries price and time. So Brian, I'm not going to ham hock my way through it because I know what it feels like, but tell everybody why it's important to marry price with the volume.
Yeah, price, volume, and time actually too, because
right.
It's, time frame is different for everyone. I might use it for swing trades, but it's also very applicable to the 1 minute scalper, where you can anchor from the 10:35 a.m. low for the S&P for the SPY, and then anchor from the 11:27 high and find value in it. It's amazing how well it works, how accurate the support and resistance levels are. I don't like to use them to be a place to blindly buy, but as a level of interest, if you draw the anchored VWAP in the correct places, you're going to find it to be amazing in terms of where the supply and demand is. It's simply, and that's what it is. It's a representation of supply and demand from any start point, and it tells you with 100% accuracy who's in control, the buyers or sellers. And no other oscillator or indicator that I'm aware of can do that.
And folks, if I had to go back in my painful 35 years, some are more painful than others, and even to this day, you don't get them right.
Yeah.
You absolutely want to know who's control of the instrument, buyer or seller, because if you're one of these people who want to buy value and get the baker's dozen and buy pullbacks, well, make sure you know how you have a plan for that, as opposed to like a hunch. Human beings, and you could read this in Simple Heuristics That Make Us Smart, people suck at prediction. So no matter how smart you think you might be, and I have amazing intuition, nothing is more powerful than looking at this, because like I said, institutions leave footprints. And by using anchored VWAP, the way I looked at it, and it just hit me last night. I was rereading the book just for, to fill my brain before I go to sleep. It's forced objectivity.
Mm-hmm. Yeah. And
right?
It's 100% objective too. There's the only subjectivity comes from where do you set your anchor. And
yes.
if you follow some guidelines there, it's really not that difficult. We want to measure who's in control from the Federal Reserve report, announcement, who's in control from the earnings report, from whatever that gap was that occurred 3 days ago. Who's in control? Are they defending that level, or is it being rejected? That tells us something really important about the unfolding psychology of that market.
And anyone who's watched this show, first of all, if you're watching my show, thanks for being here. Psychology really runs everything. I know that technical analysis and having CMTs and CFAs, I always celebrate that level of intelligence because it puts you in the upper echelon. But at the end of the day, and today, we're still mourning the death of Michael Marcus, a mentor of mine. The thing that he pointed out to me is like, you can know support and resistance and all this stuff, but you have to anticipate how the crowd's going to act.
That's how it is.
Yeah. It's crowd behavior, fear and greed, and everything in between. You have to answer the question, what would these people do at certain key inflection points? Anchored VWAP gives you I'm a visual learner, so it absolutely would give me a visual indication of who cares at what price. And that's important because I don't want to be on the wrong side of the trade. Why? Well, because most of what we do is highly levered. And so when things get ugly, they go from like, not so great to ugly very, very quickly. And so what I have found just in the short time that I've read this book is I'm looking at it and applying it to my own models, which I've evolved over decades, and seeing how I can exact a little bit more of an edge. Because even if I can pull out an extra 20 basis points, when you do that with leverage and then compound it, it could mean a big deal.
We can.
We've mentioned, or I might have mentioned in my remarks, the art and science of the technical analysis. Now, the equation for calculating this it's publicly available, no different than trying to calculate the numbers for the day's range that goes into the average true range. But picking the anchor is really the art of it all. Now, you can use news, you can use price gaps, you can use high volume days, you can do earnings. So you do have to go in there and kind of massage, what you're looking at almost on a chart by chart basis. In terms of volume, what I'm going to show, we have a few slides I'm going to show eventually when we get into it. I used a 20-day simple moving average on volume, and I looked for stuff that was more than 1.5 times that number. These were 4x, so we well hit the standard. Now, again, Brian, you mentioned in this book, because I didn't have time to do all of them, but there are 9 different ways that people can use anchored VWAP as a trade setup.
Yeah, I mean, there's probably 100 of them, truthfully, Michael. And
yeah,
this was just to kind of, get people going in the right direction. The most important part is just, simple support and resistance, a level of interest.
Mm-hmm.
And then it comes down to where do we anchor from to see if that level does in fact hold as support or as resistance. And then when we can combine it with fundamentals as well, an earnings report, it all goes back to, like you said, the psychology. It's the psychology of what are people doing after that earnings report. But then you look at the earnings report and say, hey, wow, that's pretty amazing. They sold how much of this stuff and they made how much money? Well, I look at that and I look at it kind of the fundamentals, that is. I don't care what the fundamentals are for me personally, but I look at the fundamentals and say, this is going to get growth managers interested in this stock, because compared to the other merchandise out there, the other stuff isn't, doing as well on a fundamental basis. So I know that there's going to be a potential source of demand from the people who do look at fundamentals. And then I look at the pullback to that anchored VWAP and I say, well, there's a potential demand from the people who are buying, and they want to combine the technicals and say, I want to buy at this price, this average price since the earnings report. So it is always all about psychology and trying to get into the head of the participants and find the reasons maybe fundamentally, but then where and when with the technicals.
Yeah, right, because then at the end of the day, you might have strong opinions about what the merchandise that the company is selling. You might have strong opinions about the merchandise that's for sale in the marketplace.
Right.
But ultimately, I have found, yes, when I first started, I had good hunches and good intuition. But here's the thing, I had no technique. I had really good I was a diamond in the rough. I had good intuition about what I thought was going to move, but I didn't have great risk management probably for the first 3 years. I didn't have any idea about entries. I didn't even know what the hell a breakout was, right? In full humility. And so what happens when you're dealing with traders? Somehow we all have to come down and face uncertainty. Really, that's what it comes down to.
Always.
How much are you willing to risk to be in the trade in the first place? And then when you have winning trades, how much of those unrealized gains are you willing to risk in order to stay in a winning trade? Now, some of you might peel off a third and all this and that. I'm not going to get into that because that's a personal preference. But what Brian's saying is absolute gospel in that you can't fight the tape, you can't fight the Fed, but when you're looking at anchored VWAP, where it takes price, time, and volume all in one snapshot, I think it's better than almost any other indicator because you can see it all in one snapshot. And it's pretty much black and white. You might feel strong feelings, you might disagree with what you're seeing, but if you're just starting out, in my humble opinion, you do that at your own peril. You can't fight what's objective and what's out there. If you're marrying this up with like Market Smith or Coifin, and you can see short interest or earnings dates, you can see all this unfold and marry it all together to have one really, really powerful system. You get to see, for example, if you're bullish on a news report that might come out as a surprise. Well, for one, what's happening with volume on that particular day? Because if it's big news, but the thing isn't moving, maybe it's already priced into the market, not even with the price, but with the volume, because whoever has the stock is going to hold pat.
Yep.
Earnings, you get to see how material, because listen, if you're dealing with big companies, we're going to talk about some short interest. I remember back in the mid 2000s when Netflix, we were still sending the DVDs in the mail. They were supposed to lose like 8 cents and they made 3.
Right.
And that stock was, heavily shorted and the thing gapped. So then the question is the gap going to stick? Right. So you have to use that perhaps as your anchor. So Brian, when you were doing all your studies here, I want to talk to you because since this is like your material, how hard was it for you? And this might not be the best worded question, but in choosing like the anchors, right? Because that's really the art of it. you have to take chances, right? You have to invite that vulnerability. You have to invite that uncertainty and really kind of pick and choose in a very subjective way as to where to set that anchor. Do you do it like in one particular manner consistently, or do you kind of say, well, I'm going to look at a gap on this one. I'm going to look at a high volume day on this one. Like, what would be the best way for, say, a beginner to look at setting that anchor? Because I think that's where, in my humble opinion, someone might be a little skittish as to like, okay, I like this. I like the idea. I like the ideology of it. But setting that damn anchor, I'm going to sit here and be like, ready, aim, 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 and never shit or get off the mark, basically. So where should someone start if they were looking to set the anchor and keep it simple just to get going?
When it comes to trading stocks, I think that most people start out with somewhat of a fundamental background. So, earnings reports are what drives prices at the end of the day. It's all about future expectations. Is this company going to earn more? Therefore, the valuation is low today compared to what it might be. So we're buying the stock today. Mm-hmm. So I think that, when you look at what comes naturally to people and what they've been kind of, I might argue, brainwashed into thinking about stocks, is that it's all about the fundamentals. If you start with earnings reports, especially the ones that get a strong reaction, either up or down, because sometimes we'll see, that the stock will miss numbers, the stock will gap down, and then that day, it kind of is under the daily VWAP for half the day. Then it surges above it and goes on this incredible tear for the next week or two. That becomes one of the best anchors because it's something that you're already familiar with. The fundamentals of the earnings report. And it gives you the opportunity to look at the stock and say, I don't have to buy it on day one of the earnings report, but I can wait 3, 4, 6 days, let it settle down a little bit, and then see if it's above the VWAP. Is it holding from that level, or is it just crossing back above and buyers have regained control? So definitely earnings would be the first place to start.
Yeah, because man, when I grew up and stocks were still trading in eighths, there was like the number, then there was the whisper number, and then you'd go out and get other ones research, and you'd realize like, okay, for all the smart analysts out there, the predictive value of any of this information is zero, right? It's really informative, right? It's really, and they're very smart people. I'm friends with a lot of, I teach them. So, but here's the thing, folks. If you miss a day, it's not the end of the world. Yes, if you're sitting there watching 1 minute bars, it might be painful because you kind of missed your moment in that regard. But think of it this way. If there's a stock, and you can go to most of these places and rank the top performing stocks, some of them are up 800%. So guess what? If you missed it at 8 and it went to 16, there's still a long way to go. Of course, you don't know it's going to go there, but don't feel like you missed out or that you have to act impulsively. I think that's one of the benefits of this book, is that it has a built-in pause function, and that you can see things objectively. One good or one bad day. I know that people say, if you miss the 10 best days, this and that, but guess what? Good days and bad days are clustered. So if you were so unlucky to miss the 10 best days of the S&P, chances are you missed 8+ of the down days too. So you have to be super careful. Also IPOs, right?
Absolutely.
I'm not an IPO guy myself, but for example, if you looked at the rest within crypto, you could go back and look to see when Coinbase, for example, went public and how that's holding up. You can see any other big inflection points. When did FTX go broke? When did Sam Bankman-Fried get indicted or arrested? So you can just see, like, did those news events have an impact, right? Because you don't know why people do what they do with their money.
No,
they say fear and greed, but it's really the news, especially if these investors don't have a daily methodical process that, you and I would have day after day, right? We know, like, okay, some days this isn't the right environment to start rolling the dice, right? There's a lot of fear pervading. We are kind of like, every day is unprecedented times, but it's hard enough to make money in good markets. This doesn't seem like it's a good market. And crude's up $5 today, mind you. So, again, this is objective and it's dynamic. So you let anchored VWAP do the interpretation for you. This is a great way for, as far as because people always ask me, what's the best indicator? What's the best indicator? And I'm like, price and volume for the most part. Right. But all the other stuff, really just confirm what you can already see. And I don't have that emotional need to see something on my chart that confirms something that I can either see on the chart or even better in my P&L.
Right.
Because if I'm in the right trades, they tend to start making money right away. And if not, when I'm wrong, it's usually because I'm early. So I had to cut my position sizes down by 90% because I was getting in with these full risk units and I was getting knocked out. I was in 20% drawdowns just because of bad luck, bad timing. So I was like, okay, if these names are eventually going to make money, I need to find a way to have more staying power. I got a hunch and I haven't proven it yet, but I'm going to come back. Maybe I can have you on a couple months. I'm going to go back and look at my own trading ledger and see if I was able to deploy some of these techniques, how I can improve my own stuff just as a case study, because I don't have all the answers. All I have is my own humble experience.
Well, they're not all in that book either, Michael. As good as you're saying it is, that all the answers aren't in there. They're nobody has them all yet, right? We're all searching for that elusive edge and managing risk when we're wrong, because we're going to get it wrong a lot.
Yeah. And again, I'm using a lot of leverage. And so when I get it wrong, it can be a little bit more painful than it might be for other people. Of course, I don't recommend that you do things my way. I have also stated on the show that if you have a cash account, call it 50K, doesn't matter what it is, but you can't trade, say 10,000 of that cash and get it right, by all means, don't start using leverage. Right. The only time you can start using leverage is when you absolutely know you have a definable edge and you can look back objectively and look at your own trading results and see that whatever it is that you're doing, even if it's rolling the dice, that somehow by the grace of God, you have positive expected value based on all your rules. If you don't have that, then leverage is out of the question. I know.
It reminds me, there's long ago, I read one of Martin Pring's books, and I got the line from him is when you commit your money to the market, like it or not, you commit your emotions as well. And I like to add on to that. If you leverage your money, you're going to also leverage your emotions, and you're going to find yourself doing really stupid things at the worst times possible. And, selling when you should be buying more, and the opposite. So leverage, you've got a good handle for it, but a lot of people aren't, take a lifetime to get there.
Well, minutes seem like hours, and hours seem like weeks. So these are hard-earned, learned lessons, right? No one has it easy. It took me people are like, man, it's taken me so long. I want to make money. I want to be a trader already. Well, it took me 4.5 years to figure out my backside from a hole in the ground. So if you're within that 4.5 window and you have even a small amount of respect from what I've been able to achieve, you're right on target. You're not going. The markets aren't going anywhere. They will be, as long as issuers need to raise capital, there will always be a secondary market in trading. They're not going anywhere. So I have a few slides to go over some of the trading techniques. I think Brian says it best, so I'm not going to steal his thunder and try to replicate the whole thing. So I came up with a couple of themes, right? Because that's good. I'm going to share my screen here and go. There it is. I stole this from your site, Brian, or your Twitter feed. So I'm kind of sorry, but I'm not sorry, because I just like the graphic. Looks very good.
Thank you.
Folks, you can get the book at Amazon. I don't have any financial interest. I don't use affiliate links because that shows that you're broke and you need the $4 on the sale. I don't. So the first very simple example here would be Alibaba. It's in the news at any given time for one reason or another. Fundamentally, what we're looking here at the 52-week high, I anchored this one on the big gap and the breakout. You can also trace down and see that the volume was a multiple of the lavender line, which again, just for a footnote or a key, so to speak, is a 20-day simple moving average on the closing volume. So the green bars are up, the red are down. This is from bar chart. I just use it because it's one of the few places that has anchored VWAP that you can overlay. And so I did the overlay just to, create some support and resistance. I know some of you might be using a 20 or a 50 period exponential or simple moving average. But Brian, when you look at this, just on this simple example of anchoring to this big breakout on a high volume day, what are your interpretations for the newer trader? How could they use this?
Well, so when I look at that, Michael, it looks like if I'm looking at this correctly, there's that other gap 4 days ago.
Yeah, right here.
Are these both earnings reports?
Yes.
because they look about 3 months apart.
Yeah.
And then I would say probably that low was an earnings report. If you go back to that big red volume bar, that was probably another 3 month ago event. So it looks like, it gapped up on that where you have it anchored. When it got back below that volume weighted average price and kind of, it was a little bit of a battleground there for 4 or 5 days.
Right here.
Yep. And then as it broke below, and then, 5 days later, it rallied up towards that VWAP and got sold off hard. I would have actually, I'd anchor another one from that gap down, because that would tell me
this one here.
Yeah. From that gap lower.
Okay.
That was another significant event, a change in the psychology of the market that the sellers took control. And I would have anchored it probably about, 4 or 5 days later, after it broke down below that 4-day consolidation. I would say that was an important event. So, a lot of people say, when do you anchor it? Where do you anchor it? On the day of a gap, I like to, but I also want to see how it trades around that level as well. So that now the new gap from 4 days ago, that becomes an important level that I want to measure against. One, I want to see that a natural pullback in here, if it could hold above the VWAP that you have drawn in there, that's great. And then I would want to see maybe it comes down below the anchored VWAP from 4 days ago and then starts to consolidate a little bit and then begins a new move. So this is a new momentum campaign right here. It appears, with that huge volume on that gap. So that's clearly a new level to anchor from.
And so this is where we go into multiple time frames. If you're looking at, you want to conjugate to make sure that if you're looking at intraday, 5-minute bars, 65-minute bars, you want to make sure that there's an even number of bars. And that's in Brian's book as well. And then conjugate the trend action among those different intervals. Because one day trend, sure, it can be powerful, but you put the odds in your favor by looking at Brian, that's Brian's first book, multiple time frames. So talk about the importance of looking at anchored VWAP, not just, this is a daily chart. Talk about looking at it at, intraday levels, and even at various 30-minute bars, 65-minute bars, stuff like that.
Sure. Let me go ahead and share my screen,
sure.
Michael, and I'll pull up a couple different time frames, and we can look at that together. So, for Alibaba, here's our weekly chart. And on this weekly time frame, I've got the 10, 20, 30, 40 week moving average. That pink line is the anchored VWAP from the beginning of 2022. So I just have blue is this year's anchored VWAP. So I always have the year to date, and I keep the prior year on for about the first 3 to 6 months of the year. But what's most important here is, the anchored VWAP from this peak. That's the number one thing I want to look at. So from that large decline, then you'll say, well, it's all the way up at 140, and here we are at 99. That's not really too helpful. So I want to do what I call the handoff. The last time that VWAP was touched was right here on this gap lower. And that still doesn't provide a lot of value. So I'm going to hand it off to this next control point where you saw another big decline. And there you can see that one, this one right here, held resistance there and kind of in there as well. So now if we go down and anchor to this next level, and I'm going to just color that, I'll color it red so we can see it better. Okay. So we're fighting with that one. So what we're starting to see is some of these longer term volume weighted average price levels are holding the support. They're flattening out. And just if we just clear that all up, look at this daily chart, we're still in a big range, right? If they didn't scare you out, well, then they're in the wear you out phase. And realistically,
well said.
Realistically, for a larger term stage 2 uptrend to begin, we need a higher high like this, right?
Yeah.
This is a move within this base still. And you could then even look at that and say, well, that could be a shoulder, that could be a head, and this could be the bottom of this right shoulder. Fine. Sure. So traditionally, people want to buy above the neckline. I want to see it go above the neckline. If it's extended, pull back, test, and then buy over here.
Love it.
And then set an anchor to this point, because if this is an important low. So what we'll do is we'll take a look at multiple time frames. So that's those drawings on the left, the daily time frame. So I'm just going to clear that up. and on the right is a 30-minute time frame. So this is the anchor from that earnings report right there 4 days ago. And so far, you can see it was defended on day 2. It opened at that level, and then buyers came in and scooped it up. Now, on a short-term time frame, I look at it and say it made a high 2 days ago. So now what we're seeing is the range is so far, maybe it's going to compress between these or pinch.
Yeah.
And then if it doesn't pull back, then as it gets back above here, so this is the average price since that high.
Yeah.
If it gets defended from the sellers and then energy gets compressed, well, I want to buy here with a stop under here. What I would actually prefer, Michael, is that the stock, because it's had this big run recently, from this low,
Yeah.
I would prefer that the stock kind of does this, pulls back, a little shakeout, comes back in,
Yeah.
and then does that. That grabs a lot of stops, brings new short sellers in, tests this level, and then perhaps we could come up that right side and get, back above this anchored VWAP, which might, look like this.
Brilliant. Exactly right. So if you chart on one screen, just for a second, if you can just go to the left screen and yeah. So folks, if you're looking at this chart here, I don't know if you can see my my cursor, but if you look at where Brian, if in the far left, top left corner, you can see the numbers come down from say 300 and now it's down below 100. It's come back 2/3.
Yeah.
So some of you write me and say, you hate the feeling of missing winning trades. So you have to operationally define what that means, like a winning trade. I would figure like if you got into this trade on the breakout and made even $10, but then we're in the sidelines only to watch it recapture the highs of 300, I'd say that that's not a good trade because you left the majority of money on the table. And if you're newer and you want those, see, remember, there's 2 payoffs to every trade. There's the financial P&L, but then there's the emotional P&L. If you miss where Brian's drawn the neckline here at 120 to 130, and it goes and you catch the breakout, say where he was saying after it does a little, breakout and creates some stages, call it circa 140. Yes, exactly like he had the last time. If it goes from 130 back to 300 or 140 to 300, what's the difference? And the answer is rhetorical. There is no difference.
Yeah.
So you can't worry about a $2 move. $2, again, if you're new to trading, it might be an emotional win for you, but it's not. When you're looking at the chart of Alibaba that Brian has here, if you're in a winning trade, then by all means, keep some of the good risk on, right? And so it gives you some context here that when you miss a trade or an entry, you're never really out of the trade, because if the campaign is more meaningful, there's plenty of times to get on board. Anchored VWAP is a great spot to look and see where that spot is. And it's objective, which is great because it doesn't make you have to sit there and have to make a decision when you don't have any experience.
That's something interesting there too, Michael. I didn't mean to interrupt you, but from the beginning of its IPO, the anchored VWAP had been important as support, as resistance for the first couple of weeks, then as support, then resistance. And we saw the same thing. We saw a shoulder, a head, and a shoulder over here, and it broke above that VWAP from the IPO. It came back and tested it, held perfect support at that, and a multi-year rally. Now, if you look at the anchored VWAP from the IPO, it comes in exactly as the same place as the anchored VWAP from the all-time high. So what I just drew in unintentionally is probably where if we saw a real big rally, it would find supply and see that pullback. And that pullback would likely come down to the anchored VWAP from this low, which might end up looking something like this, if I can draw it properly, something like this. So it would then again kind of pinch between those and then buy as the moment. A lot of people want to buy the breakout right here. I want to buy the resurgence of momentum right here, where I can see the higher high on a shorter term time frame and sell some to the breakout chasers. That's the way I like to look at it. Buy some in here and sell some at this point, right?
Yeah.
So anyways, that certainly looks like it's going to be an inflection level, 144. If it can, that's a long ways away from here. That's a great trade in and of itself.
Right. But this is the beauty when you're trying to play Columbo or detective as to, where things could happen on the chart. You put up the indicator like this. And again, it gives you information. It gives you data that you wouldn't see certainly on any of the financial channels. And you probably wouldn't see unless you're following alpha trends, for example, on, StockTwits or Twitter, for example, or you get Brian's end of the day note that he does. So this is all very powerful stuff because now, part of a trader's job is to have a sense of imagination, right? You have to have a sense of anticipation. So all this stuff could at the same time get you slightly excited about maybe putting this name on your wish list, but also give you a moment of pause that you don't want to get ahead of yourself. Because again, it's hard enough to make money in good markets. I don't feel we're in a good market. Right. 2, I admit that you only need 3 or 4 markets in a year to make your year, right? You're not talking about diversification here. We're not talking about buying the S&P. We're talking about being able to find a couple of good moves that you could have a solid position in to make all your money. That might happen for some of you. But definitely. I like this idea though, that it forces you to be objective and then it forces you to, take a moment of pause because this isn't randomness, right? This is longer term stuff. You're looking at, again, generally speaking, shorter term timeframes, the data is much more random than when you're looking at a longer time series. Now, we could spend 4 hours talking about randomness, right? Because it's all around us. But sooner or later, you're going to have to develop a trading edge. And if you don't have a trade point in putting on risk, unless, again, you want the action. Action means I want the emotional feedback from the market or the potential to make money. This is objective in that it can give you that moment of pause if you're at a stage in your career where you lack discipline. You lack discipline and you don't have a trading edge in this type of an environment, just go be a philanthropist and give your money to a shul or a church because at least you can direct where you want it to go. It's too easy to lose money. This is excellent analysis as far as I'm concerned. I want to, can I take back the screen?
Of course, yeah.
Okay, boom. So let me go, where'd my Zoom go? There it is. Share the screen. We're going to go move on to the next one. So thank you for that because you took an idea, a starting point, and really evolved it, which is kind of exactly what I wanted. Now we're looking at one that's always in the news, Tesla. And what I did here is I did actually anchor the last 4 earnings reports.
Oh,
now,
nice.
Brian, what's that?
Nice. I like it.
Yeah. And so again, I stole this from Brian. I didn't come up with this. This was one of the tactics that he mentions in the book. And so I anchored the last 4 because people have strong opinions about Elon Musk, which I think clouds judgment.
In both ways.
Exactly. Right. He's a polarizing figure, right? Yeah. So you have a polarizing CEO who can't stay off Twitter. You have a company that's in an exciting field. We always have fossil fuel arguments. You have the convenience of, electrically charged vehicles. But if you don't have your own charging station, it is a pain in the ass at best. So what I did here is I went back to MarketSmith and I looked and saw when were the earnings reports. And so I anchored on all of these earnings reports, the last 4, I colored them differently. They also happen to have high inflection points. When you look again, this lavender line is a 20-day simple moving average on the volume. Yep. And as Brian suggests in the book, if you're looking at volume as being a place to set the anchor, you want to think about 1.5 times. So the green bar or the red bar, right? Because either one, you'd want to see that this be minimum 1.5 times where the lavender line is. But nonetheless, what I like about looking here is that we call into sharp relief in a very visual way, something that Brian referred to in the book called the pinch. And the pinch is kind of where the price set of the instrument in candles settles between 2 different anchors. Is that right? Would that be a fair way of saying it?
Yep.
So interestingly enough, from a year ago is the solid blue line. And this is through last night because I wanted the charts to be as recent as possible, but not so recent that I put the whole thing at risk because I didn't have the charts ready. So I like to be prepared like a day or 2 in advance. So let's talk about the pinch here, Brian, because you can see there's a couple of spots here without getting confused. I have a sense that you'll do a better job of describing, what's going on with the pinch and the width of the pinch lines.
Yeah, that's key is the width. So what we're looking at is, there's Minervini really kind of introduced this or expanded it to a lot of people is, from contraction comes expansion. When you have that compression of energy, that, the stock is resting after a large move and it's building energy for the next move. Maybe we've, attracted a lot of short sellers who think, hey, the stock's up from 100, the low this year. It's doubled. I'm going to short this thing. So it brings in a lot of short sellers. Other people are, maybe some long sellers are getting out and giving it to other, longs, new longs in here. So what we see is a compression of the energy. The volume is building. I'd really like to see it get a little bit more compressed and pull back some, maybe towards that middle line where the red and the green from last quarter and 3 quarters ago are. But it's really amazing when you look at that blue line. Look at first how it acted as resistance the whole way down. Yep. And then we saw some higher lows in June, last summer, and then it poked up into that anchored VWAP. And then as it got above it, the buyers took control ahead of the earnings report. And then the next one, it broke down below it. And it's just amazing to see how these levels, so that orange one from 2 quarters ago, that halted the pullback. What I'd also like to show you, Michael, is if I could take the screen here too, is expand on this even a little bit further with the idea of the pinch from highs and lows. So that's something that, we can easily anchor to different, earnings reports. Here I've got a 20 and a 50-day moving average. That's great. They're right next to each other. The 20 is starting to curl back up. The 200-day moving average is above. The high last year, March, is right there. And that was, perfect twice, maybe 3 times after it had been support previously and then resistance as well. And now, we know that this was an important low. So look at how from that low, we saw buyers here, and then we had a shakeout. And now we want to anchor to this point and look at how this anchored VWAP is now holding. So what that tells me is we can use that. So when the buyers take control from this high, we buy above here. And now we set our stop. At that point, our stop would go under this level. As it rallies up, we now have our stop raised up under this shakeout low, and maybe it can build and do this. But, that's how I like to combine them, from multiple points, highs and lows, because you can see that they're just so damn accurate that you just can't deny it.
You can't deny it. And it's objective. So for the newer person, or for the person who's super experienced working at Tudor, you know a lot of information. You have good instincts. You have good intuition. You might be reading lots of research. You might even be, people in the business. This can help quiet the chatter, right? Because they always say the committee's in session, right? So this might help quiet the chatter because it kind of streamlines things. Brian, I want to talk to you about something that's kind of like at the heart of making and losing money, because for all the entries and exits that are out there, we make and lose by our position sizing.
Yep.
Now, so when you had some of those other charts, I didn't want to interrupt you, but the way it looked with that big breakout bar, it would seem to me with the line being right beneath there, I might be able to kind of, I don't want to say cheat, but trade the thing a little bit bigger and have a tighter stop because I have that line right there. I have that anchored VWAP right there. And if that fails, that tells me something much more loudly and clearly than any analyst or anybody could, if, since it's kind of harder to read tape now that stocks don't trade in 8 segments, right? So maybe I could trade it a little bit bigger, not being cavalier or anything, but am I onto something there?
That's exactly how I look at it. So there's, the way I view it is that's the money management aspect. Risk management is, hey, my stop is 20 cents away, or is it 60 cents away? Well, if it's 20 cents away, and I've still got to say, I still want to risk, $2,000. Well, that means I can do, 10,000 shares if it's 20 cents away. Mm-hmm. But if it's 60 cents away, I'm only going to do 3,000 shares. But is this market that we're in, is it convincing enough that I want to take that full exposure?
Yeah.
Right. So I will always look at it. And I always like to have a really tight stop, because a really tight stop says to me, I can get in with my maximum share size and still risk the same dollar amount. And I've just got more upside. And if I'm buying it right as it's starting to move, not 3 days later when it's breaking out, that's when I'm selling some to the breakout chasers.
Mm-hmm.
It's lonely when you buy that first little higher high on a shorter term time frame.
It's
In
lonely.
that lonely feeling, it comes with a lot of doubt. You're like, am I the only one who sees this? It's so obvious. What's going on? When are people going to join me? And we all have the same anxieties when we hit that buy button and commit our money.
Yes, sir.
That's what keeps us human. And that's what keeps me defensive in the trade. And when I see that and I, start to see, hey, now the volume's coming in. Now it's up to daily R2. I'm going to sell a little bit here just because I was uncomfortable to start with. Mm-hmm. So I want to reduce my anxiety in the trade. I want to take a little bit off just in case it fails. I'll most likely even raise my stop at that point. And then I'm in a theoretically risk-free position. Theoretically, because we never know what's going to happen.
Right.
Bomb might hit their headquarters or whatever it is. So absolutely, Michael, it's about getting as big a size position as possible by looking at those shorter term timeframes and really trying to find that inflection point and be ahead of the crowd. Anticipate, okay, well, if it gets moving here, the breakout people are going to be buying it in 3 days. So I want to be ready to feed some out, not necessarily just throw it to them automatically, but start watching the tape real carefully. And if it just keeps running up there and making 2-minute candle higher lows, that's kind of one of my default scenarios is that I'll use that as a stop for that first third, but it gets me to say, here are the levels, just like any successful trading strategy. Here are the levels where I want to take risk or where I want to, put it on or take it off.
That's well said. My head is swimming with ideas because when I'm everything to us is largely systematic. So I don't think I'm not infallible. Let's just get that off the table. Because everything is so kind of systematized on my end, I don't really have faulty analysis because everything is highly regimented. Of course, I can evolve my system. And again, I'm not infallible. I can be a bonehead like anybody. But I did notice when I looked over the past couple of years, which has been true, a hallmark of my own trading, is that when I'm wrong, I tend to be early. So I can anticipate what I think is going to happen. Unfortunately, for me, my P&L gets chopped up because the crowd doesn't see things the way I see it. And the crowd's always right. If I go outside and it's clear blue sky here in Los Angeles, but there's 1,000 people around me who say, man, it's cloudy and overcast, rain's coming. Guess what? Rain's coming. Because it doesn't matter what I can see. I can't fight the tape. You see what I mean? Yep. So I'm going to look at this and go back and say, okay, I'm not really a short-term trader only because when I put on a trade, I don't care about a $2 scalp. I want to make 50, 60, 100 bucks and I want to have all my money in one name. Again, I don't recommend that for people who don't know what they're doing, but you can have, I'm not cannonballing in or cannonballing out. Like Brian talked about 20 and 60 cent stops. There's an inverse relationship between position size and where you place your stop. I've adjusted my own trading to kind of scale in with 10 basis point style positions. So I can just keep buying. Guess what? If I do get knocked out early 10 times in a row, which is very, very unlikely, but it can happen, I still have 99% of my starting capital. So I have all my money, emotionally speaking, right? So you have to evolve, not you, Brian, but well, I guess all of us, we still need to evolve because the market's going to try to steal our money, and induce us to do things by pushing our buttons. I want to come back to this because I don't want to keep you on all day, but there's just too many gems here. Let's use this same chart and we'll talk about the blue line, which goes back a year, Brian, and talk about the handoff as it might relate to, say, this 6 months ago, right? Because look at the blue line, as Brian mentioned, it act as resistance. And then through here, through the next quarter, people were anticipating good news, probably. We had lower lows. We kind of held the line here until we finally broke through. But then after this breakdown from last October, you could see that the blue line, there's so much distance between the blue line and the actual price that Brian discusses in the book, something called a handoff. So Brian, hit the handoff, maybe even as it relates to the last two reports. That would be the orange and the lavender, or this, I guess that's lavender.
Sure. So actually right there in October, that gap down looks like October 1st. That was clearly, we broke below what had been support from that first earnings report. That
Hmm.
was an important event right there, that gap. Yeah, right. I would anchor one right there,
Hmm.
to kind of see how that price responds around that. And it kind of looks similar to your orange one in that, it offered a little resistance. And then when we jumped back above it here late January, that's kind of been holding a support as well, very
Yeah.
similar to the orange. And the longer these things build, because they're cumulative, the more likely they're going to kind of come together in the same place anyways, right?
Yeah.
Because the data from 200 periods ago has now just a 25 basis or 50 basis point weighting in the in the calculation. Not really, that would be a simple moving average, but when it comes to volume in that, we've got to put that in. But you can see where the heavy volume periods are going to have a much greater impact on
Yeah.
that
Which,
anchored VWAP weighting, which is
mm,
why we see the volume weighted average price from the beginning of this year becoming so important right now, because we saw so much volume after that. That's the psychology of the crowd from the beginning of the year. How well are they positioned? Are the buyers feeling good? Are the short sellers feeling anxious? And how does that equate to what's the next potential trade out of here?
yeah, I don't want to get into it right now, but this is amazing stuff. I did get a reader question from a video that I had done a couple weeks back. Can you help me better define what support and resistance is? I would say don't try to draw, horizontal lines, because you want something that's much more dynamic. I would anchor, this VWAP and do what Brian says, look at the gaps, right? They don't necessarily have to be high volume days, but they are significant in terms of price. And then just kind of see where is it holding, because that tells you what the institutions are largely doing more than, say, the smaller speculators. I'm going to move on now. Brian also talks about, there's ways to use this. He mentions 9 in the book. One of them spoke about, short squeezes.
Mm-hmm.
And if you go, it's publicly available. I think the exchanges have to report the numbers every 2 weeks. For example, top 5 that's currently, I think as of Friday's close, this was number 3 on the list. There's the Bed Bath and Beyond, which at 50 cents, I'm not sure why anyone is still short. I mean, what's left, but
Right.
who knows why. Here we have simple 250 period, simple moving averages and the closing price. And in the bottom here, I've trailed this and looked at the short interest.
Yeah.
So it tells you a lot of stuff too. As the bottom of the market was, the bottom range here was, consolidating, we actually saw shorts adding to their positions. And even as the market rallied, the price basically doubled. You could see that they added to their shorts. It wasn't until we had a recent sell-off that the market has kind of placated. So when there's 43 million shares short against the float, and if you do the math, it's 52%. It's not the highest that I've seen, but nonetheless, it's high. And Brian goes through a system, if you will, a set of rules that are objective that you can follow if you want to look at how to play a short squeeze without getting into guesswork or having hunches of what you think the company's going to do and this and that. So I went into a different, program here, bar chart, just because it's publicly available and you don't have to make a subscription. Again, this lavender line here is a 20 period simple moving average on the volume. That number is 12.8 million. With 46 million shares outstanding, so you can calculate the short interest. And I anchored it to the low and then the recent high. So Brian, improve this chart for everybody.
Well, here 2 things. First, Michael, as I mentioned, there's 2 types of short squeezes that I consider 2 types of short squeezes. One is a knee-jerk short squeeze. It's a stock like Carvana. If you scroll back up to the top frame, you see that Carvana was $200 and something dollars, $400
Yeah.
more than a year ago. So the shorts have been correct. They have this right. That's structurally they are correct in here. But short term, we get these knee jerk short squeezes where, the stock goes
Like
from,
here and here, right?
yeah, from $4 to $16 a share. I don't care what your cost basis is. That hurts when you're short. So
Yeah.
you're going to scramble and get and cover some. Now, longer term, who knows? Everyone says this company's basically dead. They're the next bankruptcy, or Bed Bath and Beyond probably first, which is why it's at 50 cents. But I personally, if there's rumors of bankruptcy and that sort of thing, I'm not. I don't think it's a good stock to trade long. So I'm not going to try to participate in the short squeeze here, because who knows? Maybe they're going to default on something and they're going to file one day. But what you're seeing here is that from that low, the buyers have been struggling to hold on to control, but they're still below the anchored VWAP off that peak. So from that point where the average short seller from that point at the top, the sellers are in control.
Yeah.
The average price from the low, they're at about break even. So this is really kind of looking a lot more neutral than anything to me. There were some fantastic moves. If you just look at the big volume spike, low volume pullback there in early January, and then another push on big volume. So I'm not sure I could really improve on your chart here, Michael, because it's just one of those emotionally driven ones at this point, I think, where a structural short squeeze is one where you've got a stock in an uptrend and the shorts are still being stubborn and they're fighting it and losing. That's a losing game.
Yeah. So one of the things that I'd point out is, some of you might be into trend following and buying an end day breakout, end being the variable that you can set. It could be 5 days, could be 20, could be 19, could be 55, doesn't matter. There's some popular ones out there, and you have these nice round numbers. This, you can't see it here, but this is 0 because of the number 10. And if you look back X amount of periods, you might look at this as a breakout. So the question though is, do you want to buy the breakout? If you look at this as being a bit of a trading range, the anchored VWAP numbers kind of create a dynamic trading range. So we talked about position sizing and taking chances. You'd have to do this enough times and test it to see if you're going to buy a legitimate breakout, say at $10.25, maybe $10.50. For example, you're still within a range where there's a lot of overhang, there's a lot of inventory, where, the people are at home saying, please, God, if it goes up a little more, I'll just sell it, at close to break even, or I'll sell it for, X amount of dollars and take my loss and walk away. This might give you a moment of pause to say, yes, there could be something interesting if they refinance their debt, if they can convert their debt to equity. Who knows what's going on? This absolutely tells you what the market thinks about those plans and all those news reports, especially when you see the garbage on like PR Newswire or PR Web or things that come from the company or people who are promoters.
Right, exactly. So on this one, Michael, when you look at $10.20 per share, here's two questions I answer before I put on any trade. One, where has it come from? So if you look at the low 4 days ago, it was $7.20 per share, $7.21. And if it breaks out at 10.20, that's 3 points on a $7 stock. That's 42% or so.
Yeah.
So it would have run 42% in 4 or 5 days to break out. That's asking for a lot for it to be able to continue after a 40% rally in 3 days. And then where does it have the potential to go before it's likely to encounter a source of supply, which might be strong enough to become resistance? And that would be, I would look at it and say $11.41, that anchored VWAP from that peak. That's where I would expect to find supply. I would expect the shorts to defend it like they did for the 4 days after. So my reward potential in my mind is about $1.20 up to that 11.40 level. My risk, however, it's just rallied 45%. I'd have to look at it on a much shorter term time frame to really kind of determine where that stop might go. So I'm going to I'll share it on my screen to show you. Can you let me take a look at that sharing? There we go. So here's the way I look at it, is look at, the personality of the stock.
Right.
It's had a couple of these runs up to this level, quick ones, right? And then what happened? Then they get the shit kicked out of them, basically. And
Saying it
it may or
nicely.
may
Yeah.
not happen this time. But when we anchor it from that peak, what do we have? We have, that's where I see the potential price target to be. So
Yeah.
now I've got these higher lows and I've got these higher highs. Is this higher low now kind of going to be the turning point where it goes lower? So I want to look at it right here and say, if the buyers are taking control today, I want to see that this stock, if it gets punched back by that, or if it does this, then I would be more willing to buy here on anticipation of that breakout.
Yeah.
Oh, I'm ahead. I can sell a third here, have my stop under here. And if it rallies up towards that, makes this higher low, raise my stop to this point as it breaks out and I sell a third, and then look for maybe holding the 2/3 up to there if it makes a nice pattern, unless it does this and breaks a higher low. So it's about the definition of trend. If it's making the higher highs and higher lows on the time frame I engage, then I'm willing to hold it. But if it breaks down and makes a lower low prior to hitting my price objective, I'm getting out right here. I'm going to listen to the definition of trend because I'm buying this emerging uptrend.
Brilliant. So folks, again, if you're just starting out, this gives you a roadmap of how to marry how do you feel, right? And how to temper your emotions by looking at the facts and then being, somewhat reasonable. Like Brian said, you saw a 42% move off the lows here. Let me just get back onto the screen. We can keep moving along here. Bang, there we go. Brian was saying in the last few sessions, we had a strong move percentage wise, right? You always want to think in terms of percentages. Yes, you have to price the risk in terms of, dollars and cents when you put your orders in. But the way you can gauge the actual magnitude of the move is to think in terms of percentages. And what Brian is saying, you're asking a lot of the stock, right? When there's still a lot of overhang, the thing's already moved up quite a bit for who knows what reason, right? So the thing here is to demonstrate that just because something has high short interest doesn't necessarily mean that it's a good trade. You still have to interpret what you see in terms of the price action, because as Brian has said a million times, only price pays. I like to say only, now after having read his book, only price, volume, and time really tell you the truth, right? And that's, you have to develop your own opinion. You can't be, and this is I want to say this actually stopping, I want to look into the camera. Traders have to be leaders. It's hard to be a follower in this business because you have to be decisive. We live in a paradigm of personal responsibility. This tool of anchored VWAP really can help you do that so that you can kind of come into your own. If you're trying to be like, I follow so-and-so's action alerts over here, or I have this Discord that I'm involved with here, you wake up every morning and what effectively your life looks like from my standpoint is that you're a Jew on Monday, you're a Christian on Tuesday, you're agnostic on Wednesday. Of course, on the weekends, you're a Satanist or you're agnostic. So it's very difficult to have the fancy word is apostasy. You can't juggle philosophies. You have to pick one and know that it's yours and then own it and then replicate that day after day after day and focus on the process. You can't look at any P&L. I know some of the short-term people are like, man, I didn't make my $500 today. To me, that's a little too anal. If you focus on the process, you'll get the results, especially if it has positive expected value. I'm reminded of this knowing that Bill Dunn was one of the greatest traders ever and was purely systematic, had 3 years in a row where he was effectively down 15%. And he's running well, or he's since retired, but he was well into, 9 figures of assets. Let's look at one more, Brian, then I want to let you go because I don't want to hog up all your day here, but such pithy stuff. We're looking at another stock that's kind of breaking out. We have simple 50 and 200-day moving averages on Crocs. Back in the day, it was a bit of a fad because it only had one product. Now they've broken out again, just for, this and that. I've put in short interest. It's 7 million shares. This one's about a 4 point something short interest ratio. And then when we look at Crocs with respect to the earnings, we have a little bit of a handoff action here. But in this case, unlike the Carvana, we have some different price action. These are earnings, the last 4 earnings. The volume also is massive when you think about it as a ratio or a reflection of the average. Again, this is a 20-day simple moving average of volume. And we see the handoff here. We see the big volume day we put in 52-week high. And then what we saw was a breakout, but then we saw the reversal. So Brian, what do you think of this?
What you've got here, I mean, look at that red one, which occurred near the low, which was when we had the handoff from the purple, which is just crazy. But the pullback there to that red one, perfect bounce in there. And then just 3 weeks ago, another perfect, it pulled back after that earnings report. It found buyers at that prior earnings report anchor. And now I love how you put the one on the peak, because from that peak, we saw that volatility and we saw the sellers come in and profit takers come in and take control until it touched the prior anchor. And now, as it's gotten back above the anchor from that prior peak, that earnings report, it tells us again that the average short seller from that peak is now losing money. The average price this stock traded at since that earnings report is $123 basically. So the average short seller is down about 3 points. And scrolling up to your previous chart, this is what you have potential for a structural short squeeze. In other words, the shorts are fighting this uptrend. Look at how that short interest is as high as it's ever been, and the stock, so they added to it after that earnings report. Well, we can then take an anchor from that and say, we can look at the number of shares. I can't really see it from here. Let me expand the screen. It looks like maybe there was 5 million shares.
You mean here?
Yeah. If you look straight down at the purple, there were about 5 million, maybe 5.5 million shares short.
Yeah.
And
okay.
at the last report, 7 million. So it tells me they added about 1.5 million shares from that earnings report. So so we know now basically that 1.5 million shares rather are down about 3 points. That can't feel too good. That's a crummy feeling. It's so now we have the potential of a structural squeeze. If this stock continues to pull back in the next day and a half and finds support at that 123 and then bounces from there, I think the shorts will start to get a little bit more motivated. They're going to try to push it back down underneath that average price and take back control. But this thing could get away from them pretty quickly in here. And you could see Crocs, I think, make a run maybe even for those highs from 2021, which are up near 180.
So again, folks, these aren't trading recommendations as much as they are, educational, to take the ideas that Brian has written about very eloquently in his book and show you what it looks like in real time. So again, I think in terms of percentages, as soon as Brian said 5 to 7, I'm thinking 40%. That's a massive increase in short interest when the stock wasn't really, at best, it's kind of channeling here. It's a $20 range. But again, they did win on the day. This is clearly a reversal day of, Victor Sperandio's written extensively on 2B reversals. And then there's another one here where the sellers took over and whatever gains we had for the day were relinquished either because new shorts were entering, right? Or there might have been some day traders in there. But nonetheless, it gives you some sharp relief that you can see how the dynamic of the anchored VWAP, how it acts as, basically support and resistance without your needing to step in and draw lines using your very subjective ideology, especially if they're horizontal. This takes into account, price, volume, and time in one fell swoop and calculates the number for you. So at that point, you're just basically interpreting what you can see, but it's very, very objective.
I love it. And if anyone does take this as a recommendation, which they shouldn't, make sure you have a stop near about 119, because if it gets below 119, I wouldn't want to be long it anymore.
Yeah, right. So again, we have to determine who's in control of the instrument. I think and I want to speak to the short-term folks because I hear them griping a lot about slippage and skid. Some of the best trades I've ever had in my life had the worst slippage and skid. Why? Well, because I was clever enough to be buying when there were other buyers who had much more muscle than I did, you see? And so that becomes an actual leading indicator for me. Is like the worse the fill, the better the trade. I know it sounds kind of weird because some of you are very sensitive. If you're, buying 1,000 shares or something intraday, you might be using day trading buying power. If you have more than a 25K. So a 10-cent move, might rock you on a couple thousand shares because of how you look at your P&L and what you're looking to do intraday, right? But from my standpoint, where I'm even buying futures, I want to hold the positions for weeks. And I'll come back and we'll have Brian on to do a little deep dive. Maybe we could talk about some commodity stuff. Heretofore, we've been doing equities, but I don't look at slippage and skid as a bad thing because I want to be buying when there's other buyers. Like Brian said, it's a lonely feeling when you're the only person buying that breakout and you're looking around saying, hello, hey, did you get any of that? Are you in that? What do you think of that trade there? So what do? You start going to social media to look for other people who are bullish to support how you feel about being in the trade. So anyway, Brian, we're coming up here on an hour and a half. I feel very guilty. I kind of feel guilty because I'm a kinder, gentler, inner voice. But I love the idea that we can go on and talk about this book till we're blue in the face. Maybe I'll look at a couple of other examples and have you back on.
Be my pleasure.
Yeah, it's good stuff, man. I really wish you the best with this. The people are raving about it. It's already got, over 100 5-star reviews.
Yeah.
I think from my interpretation of this is a good reference book to have on your shelf, but it's also a playbook in that you can come in here and start the process. Again, Brian delineates 9 setups, if you will. There's probably maybe a better way to say it, but 9 trading techniques, 9 different setups that can get the juices going. And then, like I've said a million times before, folks, the best teacher of trading is you trading.
Yeah.
You can't, people can kind of lead you in the right direction, but the only way you can calibrate, if the goal for the trader is to be, have a system with which he, she, or they are compatible, you have to actually do it because that's the only way that you get the emotional intelligence. The book here and the tactics that Brian speaks about is very salient because it gives you a very objective way of looking at price and volume in time without having to make a lot of decisions and starting to second guess yourself, you see? So I would recommend that you get it. You don't know your trading edge. This is a good place to start. Very well done, Brian. Excellent work, buddy.
Thank you.
All right. Well, I want to call it a day here. Brian, I'm going to have you back on the show. We can take this and maybe do a part 2 or a deeper dive.
Sure.
Nuts and bolts for folks who want like a part 2. And I'm always game for that too, because look, I don't have all the answers. All I have is my 35 years experience, but I'm not infallible. So
none of us are.
Amen, brother. Great book. Thank you for being here, Brian.
Thank you, Michael. I appreciate it.